Let me finish this hole first.
Okay, Tim's going to finish the hole. Oh, get there. Big bounce.
Come on, man. This game's so dumb.
110 yards.
That's why I don't play.
This game in general, or golf?
Mostly
as a
this
whole?
game.
Okay.
Maybe golf as a whole, though.
Golf as a whole.
I might be swearing it all off.
I think this is why we're at the helm right now in North Charleston. This is the first time I've ever seen anyone play a hole that wasn't the 7th hole at Pebble Beach, and this might be why, because I don't know if you can actually hit a ball farther than 110 yards, just based on what I've been seeing here.
535. I'm going to put the club down. Let's answer some questions.
Hi, I'm Tim Bratz, and every week I sit down with the top influential entrepreneurs in the country to discuss how to leave a true legacy in all things happiness, health, wealth, and wisdom. This is the Legacy Podcast.
Let's talk investing or finding investors, and from a perspective of maybe just getting started and raising money for the first time. What do you find that people get wrong when they are first kind of getting started and first trying to find an investor base for their deals?
I would say that most newbies go at the neck of the investor and scare them away, right? It's kind of like a psychology part of it is fishing versus hunting, right? People go straight at, it's like a salesperson when you walk into a retail store and they're like, hey, do you need help with anything? And you're like, obviously there because you need to buy something or you want to buy something. And you're like, no, I'm fine. And you push them away because nobody likes salesy type folks. And I see early capital raisers, they get afraid to have an actual conversation with somebody. And so they'll just spam out a bunch of messages and they're super cheesy and they try to oversell it and they include everything right out of the gate and just fire hose somebody with the opportunity where it's this person didn't even know that you were raising money for deals, maybe that you were even in real estate. Cultivate the relationship first,
right.
And start just kind of putting it out there and educating people instead of trying to sell people on it.
How hard is it though, as you're starting out, to fight against the idea that you have to have everything lined up, that you have to have a proper offering memorandum and all that stuff, because you want to look like you know what you're doing, and that's a way to do that, but you're saying that's not really necessarily the most important thing when you're first starting out. Or is it? Or how do you balance that? Looking professional and making sure that you have your ducks in a row, but also focusing on cultivating the relationship.
I think it's two-part. First, people ask, do I go and raise money first or do I go and find a deal first? I'm a believer that you go and raise money first, right? You should probably be doing all of them, both of them at the same time, all the time. Once you're full-time into it, you always need to be sourcing capital. You always need to be sourcing deals. At the beginning, I am always talking to people about potentially investing in different projects. At the beginning, even if you don't have a deal, I would go and plant some seeds with prospective investors. All right, you know who I focus on is entrepreneurs who are not in real estate. I also do recruit, that's probably 70 or 80% of the private money that I raise. Probably 20% is real estate professionals. Another 5% would be accredited.
Whoa, something fell. Golf ball somewhere. Right. Accredited investors.
And then the other, 0 to 10% would be accredited investors, even if they have a full-time job, but they make $200,000 a year or more. Those are my A players. And so I would make a list of those individuals and then reach out to them, say, hey, I'm looking at some different real estate deals, still in the due diligence phase, so I haven't finalized everything yet, but I just wanted to see if you'd have any interest in partnering up on this with me, right? Well, how could I help? What do you want to do? What can I bring? I can do all the work. What I'm looking for is an investor partner, right? You can be completely passive, and then we'll figure out a deal that makes sense, And I think a simple way to structure, especially let's say we're talking about beginners right now, right?
Sure.
So obviously syndication and bringing a lot of investors into a single deal is very, very different. But from a an early deal, what I would do, let's say I was either going to do a flip or I was going to buy something with investor money and then I was going to refinance it and hold it with bank money after that. I would say, hey, Jed, do you have any interest in passively partnering up on the money side? You say, what does that look like? Well, hey, I'll either pay you 10% or give you 15% of the profit, whichever's more. How's that sound? Hell yeah, I'm in, right? 10% smokes what anybody can get in a money market account or in a bond or anything like that. So it's a better return that they're getting, and it's kind of a safety basis where you know it's not going to go below the 10% return on your money, and you're actually kind of on the ride as well, where there's some potential for additional upside.
Yeah, but what were some of those early objections when you were starting out from your investors, from people who turned out to be investors?
Yeah, I wouldn't say there were like objections. I think when you go with the approach of educating people on a deal, like I don't know of anybody who's ever been like mean to me when I presented an opportunity for them to invest. I don't know of anybody who like really critiqued or criticized the deal. Maybe somebody said, hey, now's not the right time, this isn't the right deal for me, that's not the kind of projects that I invest in. But nobody like was ever mean to me, if that makes sense. From an objection standpoint, we're kind of going back to your previous questions, like how organized and how professional do you need everything to look? Like, all I had is I put together like a one-page document in Word, and I would just put some general information in there. Hey, I'm going to buy it for this much. I'm going to renovate it for this much. I expect this much in holding costs, and the after repair value is going to be this much money, right? And so I do expect this much in profit. Mm-hmm. I could pay you either 10% or 15% of the profit, right? Whatever's more. So like that's very easy for the flips. When it comes to raising money for like a rental property, I might say, hey, I'm buying this apartment building for $500,000. It's 4 units, and you come in and give me a check for $150,000. That's 30% down. I'm going to use that to buy it and close on it, and then let's say that it's already stabilized. Let's not overly complicate it. And then I would say, hey, I'm going to pay you either some certain preferred return and give you a percentage of the equity in the deal. Maybe I give you 10, 20, 30% ownership in the deal, and you're the first money that gets paid. So of the cash flow that comes in, obviously I pay the bank mortgage on it, I pay any operating expenses on it, but then the next money that gets paid is to you. Maybe I pay you, 8% on $150,000, which would be, what is that, $12,000 a year? So I pay you $12,000 a year. It's $12,000.
Sure, yeah.
You get the next $12,000, and then we split where I make 80% of the profit beyond that, and then you make 20% of the profit beyond that.
And that's
or it could be a simple 50-50. Hey,
yeah.
You get 50% of all the cash flow, I get 50% of the cash flow without any sort of like preferred return. So that keeps it clean, keeps it easy, keeps it simple. You're bringing in the money, I'm getting the loan and doing all the work, and then we do a 60-40 split or a 50-50 split.
We've got more investing questions, but you touched on something there that I want to, sort of an overarching thing that I think is part of your core value is you want people to be on board with you. You want people to be your investors, your property managers, whatever it may be. You feel as if, and it makes sense, that if they're rowing in the same direction as you, you're going to get to where you want to go faster. You like them to have sort of locking arms with you as opposed to sort of, and that's why you're happy to pay a certain amount over, or the next amount of money comes to your investors because you like that idea that everyone's kind of working together on something.
Well, I mean, I've given up way more equity, way more money than I ever needed to, kind of to make an investment in the future, right? To make an investment for future opportunities, future deals, and build those relationships with investors. I started investing at the age of 22 years old, 23 years old. And so and it was in 2008 when the market was collapsing. Right. So nobody was going to invest in a 22, 23-year-old kid who'd never done a deal before in the worst economy in 80 years that was caused by real estate, right? And that's what I was trying to invest in. So it was very difficult to go and raise money in that circumstance. So I realized I need to give up more in order to then build these relationships, because it wasn't about this deal. I think that's probably a big mindset shift from a lot of newbies. It's like, no, well, I can't give up that much equity. Why would I ever give up 70% ownership on this deal? Because it's not about this deal, dude. It's about the next 10 deals that you can do after you've built the relationship on this one and you've gotten the credibility and the experience from this deal, right? You're getting paid to be educated on somebody else's dollars, right? So you need to understand that it's not about this deal. It's about the next 10 deals and then the next 100 deals or the next 1,000 doors that you can buy because you gave up a little bit on this one. I gave up 70% ownership on the first 150 doors that I purchased, all because it built this resume for me that allowed me to go and buy 6,000 more doors.
Yeah. You didn't take an acquisition fee for the longest time on a lot of your deals. Do you regret that now? Do you think you should have taken an acquisition fee earlier?
Yeah, I mean, dude, there were some, you got to keep the lights on. You got to be able to pay your team. You got to be able to pay for marketing expenses, operating expenses, going and visiting the property. And we did all that out of our own pocket because we had this flipping business over here that allowed us to then spend our own money. But that also became a distraction from managing the early apartment buildings that we were doing. So it was like you get tugged in both directions. If I'm an investor, I want, if I'm a passive investor, a limited partner in a deal, I want the general partner to be all in 100% on that deal that I'm investing in. And so I don't want them worried about putting food on the table and keeping their lights on and paying their team.
Working a 9 to 5.
In a different role or in a different business. I want them all in here, and so I'm okay with them taking an acquisition fee. And that's something that, probably my own mental block and my own mental barrier that I had was like, I can't take any money until all the investors get their money back. And that was like a cool thing to posture up and talk about. But the reality is it created additional constraints on things that probably didn't need to happen, and I wish I would have taken an acquisition fee earlier and then been able to be more focused earlier.
What are maybe some of the other things in terms of investing that you didn't do when you first started out that you wish maybe you would have? Is there anything else?
There's a million things, right? You learn from every single one of them, but like different contracts and how you contract properties and different out clauses or different terms in those purchase and sale agreements. Yeah, so like one of the first apartment portfolios I ever bought was 74 units. And my attorney gave me this templated purchase agreement, and we went to go and buy it. And the seller wanted to cross out a section that was called representations and warranties, like reps and warranties. And all that section says is what I'm telling you, to the best of my knowledge as a seller, is known to be true and accurate. That's all it says. So if a seller wants to remove that from the contract, that means they're either telling you lies or trying to hide something from you. And so that's something that I didn't even know early on and had to go through the process of this happening. And my attorney's like, no, don't let them do that. So we left it in there. They lied to us anyways, defrauded us anyways. And there was all sorts of stuff that we found out about the property after closing occurred, to the point where there were like HUD contracts and all this stuff that we were supposed to be approved for prior to buying the property. It didn't happen until after. They didn't even notify HUD until after we had closed, and HUD withheld all rents. Like they had 80% of the units in the building, withheld all rents for 10 months until we got approved, just because they thought we were the ones acting in bad faith as opposed to the seller. And so we were able to then go back to the seller. They hid a bunch of other stuff. There was a bunch of other issues, and we were able to then file a lawsuit against them. They defrauded not only me, but my investors that were expecting to make way more money on this deal. So we filed a lawsuit against the seller and ended up winning that lawsuit, all because of the reps and warranties clause.
If I'm just starting out and I'm watching this, I'm saying to myself, why would anyone invest with me when they could just invest with you, right? Why would anyone put money with me who I don't have any deals under my belt when they can go on Tim's Legacy Wealth YouTube page and see all of his expertise? What would you say to that person?
Yeah, so great question. Utilizing what seems like a weakness and turning it into a strength was something that I got pretty good at earlier on in my journey. So when somebody would be like, well, I can just go invest in this firm that's already got 10,000
Right.
doors or something. I was like, listen, yeah, you can invest with them, but at the same time, they are the one that calls the shots, right? They're the one who is seen as less risky, and so they're not going to pay as high of a return as I would pay, right? You and I could sit down at a coffee table and we're partners. We're in on this thing together, and I'm willing to give you equity and pay you a higher return because I understand that I'm younger or I'm newer or I'm less experienced or I'm whatever it is that you think might be. But dude, some people appreciate that. Some people don't want to be someone who just writes a check and gets an update once a
Can't
once
get
a year,
anybody
once
on
a
the
quarter,
phone.
Can't get anybody on the phone. Can't talk to the actual head
Yeah.
guy. And this was a way that I was able to differentiate myself. Like, I'm the one going to the properties, meet with the contractors, sitting down with you, and being able to then work through the deal, right? So you can have real feedback, and that a lot of investors, a lot of LPs like that, especially if they've been in the game and they're trying to get out of flipping, they're trying to get out of hard money lending, and they just want to invest as a limited partner, as a passive, more of a passive role. They still kind of like can be active without having to be the person. So I attracted a lot of investors that way that would put some money with me, could still get the great returns that they were getting as an active partner in whatever their business was, but they didn't have to do all the work. And so utilizing whatever you think might be a weakness as your strength is the way to go.
Yeah. When you are setting out to find investors, how important is it to make sure you've already had a conversation with someone who can handle the legalities of everything that you're doing?
What do you mean by that?
In terms of making sure that you're being SEC compliant, making sure that you have kind of all your ducks in a row before you go out, because I'm sure that people who are investing with you are sort of asking the questions like, is what I'm doing legal?
Yeah, so here's the thing. I didn't start out syndicating with hundreds of investors on a per deal basis, right? I started out with one investor to one property. They would loan me money. In most capacities, we were buying and flipping turnkey single family houses and buying it, renovating it, putting a renter in place, packaging it with management, and then selling it to somebody who just wanted a predictable return. In that scenario, I was able to raise $100,000 from somebody, and they were able to get a mortgage and a promissory note on the actual property. So because it's secured by something, you're not creating a security, which means you don't have to register it with the SEC or anything along those lines. So that was how I got started. Then maybe I created an LLC, and you come in for the cash and I come in and do the work, and we just do some sort of equity split, 50-50 on the LLC. But you're a partner and you have voting rights, and I'm a partner and I have voting rights. If you have voting rights and you're a partner in the deal, then it's not creating a security either. And so you don't need all the private placement memorandum and the SEC paperwork and all that kind of stuff. If you're sticking one property to one investor, as soon as you start bringing multiple partners into a single deal, and they're passive, where they don't have voting rights, they don't have decision making, you are creating a security. In that scenario, you pick up the phone and you call an attorney that helps put private placement memorandums together. And you could just look up SEC attorney or private placement memorandum attorney, real estate attorney, pick up the phone and call someone and say, hey, who do you know that can put the documentation together for me to go and syndicate capital? And somebody, whether that's the person or they connect you with somebody, within one phone call, you'll be able to figure out who the attorney is that you need to hire in order to put the paperwork together. I had no idea what I was doing with the paperwork, but I hopped on a phone call. Mm-hmm. The attorney asked me a bunch of questions. They came back a week later, asked me more questions. And within 2 to 3 weeks thereafter, I had all the syndication paperwork. Then I could then present it to my investors. They can share it with their CPAs or their attorneys, or they can review it themselves and then say, I'm in on this deal, or I'm not in on this deal, or I have questions about this. And I just leaned on the professionals. I didn't need to have all the answers. What I needed to do was have the capacity to pick up the phone and call people to figure out who would have the answers, finding the who to do the how.
Yeah, I know this is going to be sort of a question that you could answer in a bunch of different ways, or maybe not necessarily put a door count on this type of thing, but if you are eventually trying to get to 1,000 doors at what point do you start raising money in a fund as opposed to raising money for individual deals? Is there a benchmark you can look at from that standpoint?
I have found, after buying 6,000 plus doors, it is far easier to raise money on a per deal basis than in an open-ended fund. It's very difficult where people can't actually look at a deal, they can't actually understand the business plan, they're working off of all hypotheticals, and they realize you've got $100,000 or $500,000 to invest in a deal, you realize things don't always work out as hypothetically put on paper, and you want to see an actual deal. It's far easier to say, hey, do you want to come in on this deal over here? I'm buying 123 Main Street for this price point. We're going to renovate it with this much money. I have a loan lined up at this interest rate. Here's where the current rents are. Here's where those current rents, or where the market rents should be. And here's the timeline that we're expecting it. Here's how much equity value and the stabilized financials look. And dude, I'm painting a picture that shows the entire understanding of that deal. And so it's far easier for somebody to come in and say, this makes sense. Let me allocate $150,000 to this deal. And Tim, let me know what the next couple of deals look like. I'm gonna put 150 here, 150 there. So they have more control over their diversification into what deals that they're buying, as opposed to, the operator dictating this much money goes into that deal, this much money goes in that deal, this much money goes into that deal. Right. I found it's like, I'll give you an example.
So it's not something you should be aspiring to graduate into?
No.
Okay.
I actually, I have a fund, but our fund has, I don't know, $6 or $7 million into it right now. And we launched it 9 months ago. So that's, in most capacities, that's pretty good. But I've raised $145 million on a per deal basis over the past, 6 or 7 years. So it's like, it shows you, even somebody with my level of experience, it's still a hard thing to raise money on in a fund.
Let's say that you have an investor comes in for $150,000. You pay him a 10% pref for 3 years. Then once you refinance, you cash him out. So he's made all the money you said he was going to make. He gets his principal investment back, and you go to him for another deal, and he's like, no, I don't think so. How do you get over the mental hurdle of doing everything you promised for people, but they're not along for the ride for another investment? I
think understanding that this whole raising money game is about timing is really, really important. And just because timing, I'll give you an example. One of my best investors, many, many millions of dollars with us, his daughter just went to college. And she went to college, and he needed a couple more bucks to then pay for college housing. I think he was buying a house at her university that she and some friends could live in, so they're kind of house hacking her college house for the next 4 years. Obviously, there's tuition expenses and books and all the other stuff too, right? So I just paid him back on a deal and said, hey, and he always has rolled it forward for the past 7 years that he's been with me. And he took $100,000. He's like, hey man, I'm not going to roll this one forward, but I do have some other deals paying off, and we'll bring some more money later. I don't take offense to that, right? He's got life happening, and that's the situation. That's totally fine, and you can't expect everybody to give you every single dollar of theirs when you're raising money. And you got to realize there's life circumstances that happen. People get sick, kids go to college, there's certain tuitions that need to be purchased, somebody's buying a new house. One of my investors who consistently writes me a check for $100,000 every 6 months hasn't in the past 9 months or whatever, because he paid off his house. He's like, hey, you know what I want to do? I just want to pay off my house, not have to think about it anymore. He owed like $200,000 on it, so the check that he usually writes me at the beginning of the year and middle of the year went towards paying off his house. What am I going to do? I can't get mad about that, right? It's just a life circumstance that happens. And he's like, hey, I got my other check for you at the end of the year for another $100,000. And anything that pays off, roll it forward. So just understanding that life happens and investors have different circumstances, that's okay, man. And just your job is to keep on planting seeds, keep on talking to new investors all the time. Because what I do see newer folks get in trouble with is they have one capital source. That's the only capital source that they go to. And as soon as that either dries up or something goes sideways, a deal doesn't play out the right way, or that capital source starts being the tail that wags the dog and starts calling the shots.
Yeah.
And I've seen people get sandbagged at the closing table last minute and have to give up either more equity or more preferred returns or more whatever, all because they only raise money from a single source. So having a lot of different places that you can go and raise money from is an important aspect of this business.
How hard is it to get your first deal under your belt and then have to deal with everything that happens after you close on a deal, but also still keep in the front of your mind that you still need to be cultivating investors for future deals that may not have happened yet, when you're so overwhelmed now with another new process that you have when it comes to managing a property and making sure that it cash flows and all of that?
I mean, that's where teams come into play. When you have a team that's handling the operations and you can stay in your lane and focus on going and raising more capital, that makes their life easier and that makes your life more focused. Also, just understanding how to integrate it into conversations. And sitting there, I hang out with entrepreneurs. I hang out with business owners. I hang out with people who care about personal finances and are talking about dollars and decimals all the time. And because of that, naturally it comes to, where are you investing your money? What kind of returns are you getting? Do you have any depreciation to offset those gains? Do you get equity upside? Is there limited downside? And I'm having these conversations with people, and just by having the conversation, it comes into, I got a deal over here, might be able to partner up, might be able to come in on it, and here's what it looks like. So doing that, and then what I would say is what we're doing right here is having social media, right? And having conversations that get documented, that then get utilized on social media, so that way you can educate people in an evergreen fashion, right? I can create a video one time talking about how we raise money and how we pay our investors, put it on social media, and it sits there and it plays for somebody at 3 o'clock in the morning when they wake up and they're looking at their phone while I'm sleeping. Also, 300 people could watch that video, and I only had to make the video one time. And so, again, leading by education as opposed to selling is probably one of the most core principles in raising private money.
Did you think that social media would have the impact that it has had for you in terms of raising money? Did you, before you started? I mean,
no,
I think you may have realized that it could potentially, but I know that investors, people pop you on social media and say, "Hey, I've been following you for 3 years. I'm ready to commit," and that just out of the blue type of thing.
So that was surprising. I knew social media would create a lot of credibility, because people started hitting me up and asking me to coach them, asking me to train them, asking me to mentor them. I became intentional when enough people started hitting me up and asking me that question. I became intentional about educating operators. That then drove a publishing company to reach out to me and say, "Hey man, we're an events company, we can host the events, you just come on and you coach and you educate." And then they started running ads that ended up attracting both operators and passive investors. People would come in and be like, "Dude, this is amazing, I'm gonna go and implement this in my own market." And then other people would come in and say, "Dude, I had no idea how much work goes into this and what you guys take on, but I could write a check. Can I just put some money with you guys?" And then all of a sudden that snowball started rolling. So I realized by having both trust and respect,
right,
that's what drives influence. That's what drives influence, where people want to either pay you to coach them or invest in your deals and trust you, right? So how do you get trust and respect? You get trust and respect by educating people and inspiring people, right? Educating people shows them that you know what you're doing, and sharing stories of inspiration of how I got my teeth kicked in on the first early deals and what I learned from different things, and being completely vulnerable and transparent on that stuff, and trying to help people with their life and trying to help people with their business without getting anything in return. It does get something in return because it builds a lot of trust, right? Those people now trust because they see I'm a normal person. I'm a family guy, and I like to do the same stuff that they like to do, and I have the same goals that they have, and so by having respect, by showing that you know what you're doing, having trust by wanting to inspire other people, those two characteristics is what creates influence, right? And,
Yeah.
and that's what you need in order to then be able to go out and raise money.
Do you think that's a mistake that young newbie people in this game make, is that they're not vulnerable enough, or they think that they have to be somebody that they're not in order to attract people into their deals, people into their ecosystem, is to sort of keep people at a distance in terms of the struggles that they've had?
You know, looking back, I've seen people fake it till they make it, right? And go through that psychology, and it worked out for them. More times than not, that doesn't work though. More times than not, it turns people away. More times than not, it gives people a bad sense about that individual who's faking it. Because somebody who's sophisticated enough to write $1 million check or a $100,000
Right.
check usually has been around the block long enough
Right.
and understands enough about people and has social awareness and self-awareness where like they can see through that. So I've always been a believer that like honesty is the best policy. Just be transparent, be authentic, and just let people know. Hey,
Yeah.
Jed, listen, man, this is my third deal. I'm not a newbie. I've done a couple of deals. Here's how these two played out.
Yeah.
This is the third one that I'm taking down. And guess what, man? I want to be your retirement policy. I want to be your retirement plan, right? I'm going to be working and doing this business for the next 30 years of my life. I want to be the guy that you're like, I just give my money to Tim, right? And I just write checks to Tim. He's
Right.
my retirement plan. He's going to keep on paying me from the time I'm 60 years old to the time I'm 90 years old, as
Yeah.
long as I'm investing in his deals. Like, for somebody who has that much more experience in life and is older than I was, that was my kind of my pitch. Like, let me be your retirement.
Yeah.
You're 15, 20 years older than me. You've got a lot of experience. I'm willing to work. When other people are, spending time with their kids and their families and on vacations and playing golf for 6 hours a day and all that stuff, I'm working, right? I got no family, right? I'm not married. I don't have any kids. I have a long distance girlfriend and who lives 5 states away. I'm here to work, and that's what I'm doing here.
I've heard you say before that somebody who tells you that they haven't had a deal go bad is either lying or hasn't been around enough, and investors can, as you mentioned, investors can kind of see through that when people pretend that
Well, dude, that's
it's all
what builds
been
trust, right? By building trust, I talk about the deals I've lost money on. Hey, here's what happened in my first deal. 44-unit apartment building. We thought we'd flip it in 6 months and make $300,000. Found out that it wasn't. Physical occupancy and economic occupancy are two very different things. And so it was 80% physically occupied, but only 20% economically occupied. So we had to kick out 60% or more than that, 2/3 of the tenants, or 3/4 of the tenants, kick them out, and then turn those units, which took time to kick them out, took time to turn the units, took additional money to turn the units. I ended up having that property for 1.5 years, sold it, and I lost 50 grand on it. But I lost 50
You
grand.
lost, yeah.
My investor didn't lose 50 grand. And because that investor didn't make a return on their money, they got all their cash back, but because they didn't make a return, I gave them equity without having to invest any more money with me. I gave them equity in another deal that I was buying at the same time.
And that goes to the long-term mentality, right? Because you could have very easily and legally said, sorry about your luck, sorry this deal went south, I'm taking it on the chin and so are you. You decided not to do that, and I'm assuming you decided not to do that from an integrity perspective, thinking this isn't about this deal, this isn't about the money I'm losing, this is about my name, and this is about the people who will come back to me if they understand that this is what I'm about and this is what I'll continue to be about when deals go better.
Yeah, I mean, there's a quote that I heard in a movie once and resonated really, really well with me was if you lose money, you lose nothing. If you lose your health, you lose something. If you lose your reputation, you lose everything. And especially as somebody who's newer or younger or gonna be in this game for a long time, the last thing you wanna lose is your reputation. So, dude, just in self-interest, don't lose your reputation and do the right thing. You know what that did? Is that individual, who, by the way, waived...
The person who loaned you the money on the deal that went
on the
south.
40/40.
Yeah.
He goes, by the way, at the front end, I said, hey, let me just pay you a 10% return and I'll kick you 20% equity in the upside. And he goes, no, I want 50-50. Don't pay me any return. And I want to be 50. He dictated that he wanted to be 50-50 on this. So he was 100% paper wise, legally responsible for 50% of that loss.
Sure.
And not getting any upside on his money. But by making him whole and giving him some equity in another deal to make up for the return that he didn't get on this initial deal, he became a huge fan, right? And he became someone who would go out and be a cheerleader for me and be like, Bratz is a stud, here's what he did for me. And guess what? That story has probably, being able to share that story, has probably been able to raise millions and millions of dollars for me, because I've been able to say, here's how I respond when a deal goes sideways.
Tim, thanks for catching up with us on investing and finding investors. We will maybe do a couple more of these as we maybe hit a couple shots the next time that we sit here and talk. But
let's do it.
If you have any questions about what we talked about, make sure to drop them in the comments. We'd love to hear from you. Tell a friend about the Legacy Wealth YouTube channel, and we'll see you next time.
Be your best.